Hello everybody, and thank you for watching this video. In this video, we'll be going over Chapter 3, which is Processing Business Transactions. More specifically today, we're going to be talking about the uniform system of accounts. We're going to be understanding or recapping an understanding of accounting as an information system. We talked about that, a lot about that in one. We're going to work on being able to identify business transactions. We're going to, through review, be able to understand the accounting cycle. We're going to teach you and have you apply the rules of debits and credits in order to post to the general journal after we introduce that to you. We'll also be able to conduct a transactional analysis, and then we'll show you what a completed general journal looks like. I will also be posting another video after this about an exercise of going and actually journalizing some transactions. So here's our recap of accounting as an information system. It's kind of a machine. It's just an accounting machine. There's an input to the machine. The machine processes the information, and it gives us an output. You might recall that source documents are the input to the accounting system or the accounting machine. The process by which we turn those source documents into actual usable information is called the accounting cycle. And then the output is information to management in the form of financial statements. So that's things like your income statement, your balance sheet, and your cash flow statement. What we're going to focus on at the beginning of this video here is the business transactions. Business transactions are the business transactions represent what actually happened in source documents. Source documents are evidence that business transactions actually happened. So by extension, business transactions are actually the input to the accounting cycle. We understand business transactions as values being given and received. As value is being given and received, there will be some sort of document to show that a transaction is happening, right? An example from my experience would be a supplier drops off food inventory at your restaurant. You're given the food inventory. That's the value that you're receiving, and you're promising to pay them the price for that inventory when you're given an invoice. That invoice actually also represents the source document. It shows that a business transaction has occurred. Business transactions are the raw materials of the accounting process. They can come in the form of cash receipts, sales slips, or invoices. All of these documents, so invoices, cash slips, and sales slips, all show where money has gone and where it is going. Or sorry, where it's coming from. For example, an invoice shows that at some point money is going to leave my bank account and go into the supplier's bank account. So it's showing the transfer of money from my bank account or my ownership to my suppliers. It's also showing the transfer of ownership of inventory from my supplier to me and my restaurant. The accounting system essentially collects all these business transactions or source documents and puts them through a bit of a process that organizes them in a specific manner, organizing money into different accounts that we collect and turn into financial statements. Business transactions are like crude oil or food supplies. We need to process them a little bit in order to get to the end product of financial statements. That process follows several steps. First, we have to identify if a business transaction has occurred. Step 2 would be to journalize these transactions and then post to the general ledger. After we've done those two things, we then create a trial balance. The trial balance allows us to understand if we've conformed to the rules of debits and credits, which we'll talk about in a second, and to whether our assets equal our liabilities plus equity. After we take the trial balance, we make adjustments to the general journal ledger um, by posting different adjusting entries, and then retake the trial balance just to make sure everything's still balancing. We then do our closing entries, so we close our expense accounts and our revenue accounts to income summary and retained earnings. And then after we've done that, we've identified how much our profit's going to be and the ending balances of all our accounts. We can start to prepare our financial statements. A collection of transactions are like puzzle pieces, right? On the left-hand side of the screen here, you have 4 puzzle pieces, right? Individually, they don't really paint a financial picture of what's going on in an organization. However, if you have enough transactions, you can put them together to create a picture like the right-hand side of the screen. So once we take all of our transactions, put them together through the accounting process, we'll have a better picture of how the business or organization is doing financially by looking at different financial statements. So here's those first 3 steps of the accounting cycle again. This is how we put the puzzle pieces together. First, we identify the business transactions have occurred, and then we record them in the general journal. This is called journalizing. We then post to the ledger, or the general ledger. To conduct a business transaction analysis, or to identify if a business transaction has occurred, we have to look at the business transactions and consider, did my business receive value from another? And did my business give value to another? So was there an exchange of values? To answer yes to either of those questions is to identify that a business transaction has occurred. For example, if I'm purchasing food inventory for $300 cash, the value that was given from my business to another business or the supplier is $300 cash. The value I'm receiving in exchange for the cash is $300 worth of food inventory. Identifying a business transaction analysis is actually pretty important for 2 reasons. One, we don't want to include unnecessary information into our accounting process, but also because it helps us with issue identification. So that's helping us identify what accounts are being affected. Sometimes we can look at a transaction or the description of a transaction and easily identify what 2 accounts are being affected, but sometimes it's not always the case. So if you're looking at a particular business transaction and you break it up into value given and value received, a lot of times you'll be able to hash out or identify which accounts are being affected. For example, the value being given is $300 cash. So what this means is at some point, when we're journalizing, we know this transaction is going to affect cash or our cash account. If we then identify that the value received was $300 worth of food inventory, we know that when we're journalizing, we know that this transaction is going to affect our food inventory account. Step number 2, which is journalizing. After we recognize that a transaction has occurred, we have to record that transaction in the book of original entry. The book of original entry is the first time accounting information is being recorded. The book of original entry is also known as the general journal. It shows how each transaction is affecting different accounts. After we do this, in order to organize the information in the general journal, we need to post or organize that transaction using the rules of debits and credits. Debit means the left-hand column, credit means right. These rules show us how transactions are increasing the amount of money in different accounts. Now, these rules, while left and right is pretty simple, these rules can differ between account types. Here are your rules of debits and credits. Assets increase on the debit side of the journal, or you show an increase, more money going into asset accounts on the debit side. You show that asset accounts are losing money by posting information to the credit side. Liabilities and owner's equity the opposite way. So if we want to show an increase to either liabilities or owner equity accounts, we show it on the credit side, or we record the increase on the credit side. If the amount of money in a liability account or equity account is decreasing, we post that amount of money to the left-hand side. You might be asking yourself, okay, so why do we have to complicate this? Why are we changing the rules? Why can't it be one rule for them all? Well, if you think back to the foundational equation for the balance sheet, which includes asset accounts, liability accounts, and owner's equity, the equation is your assets must equal your liabilities and owner's equity. So based on that equation, your assets would behave differently than your assets and your liabilities and your owner's equity, because it exists on the opposite side of the equation. It's a very similar rule applies to our revenue and expense accounts. The debits and credit rules about a revenue account is if we want to show that the amount of money in our revenue account is increasing, we show that or record it on the credit side. If we want to show that the amount of revenue is decreasing, or we want to decrease the amount of revenue in a revenue account, we post it to the left-hand side to decrease it. And then we do the opposite with expense accounts. If we want to show that the amount of money, or we want to show an increase to an expense or a cost account, we post that information to the debit side of the account. And then if we want to decrease it, we post it to the right-hand side of the account. Excuse me, these rules, regardless of how you've interpreted debits and credits in the past with retail credits or credits from the bank, completely wipe those rules out of your mind. It's much easier to comprehend these debits and credit rules if you really bring a beginner's mind to the table. And we'll practice these. So we use the rules of debits and credits in the general journal, the ledger, and the trial balance. However, the first time that you will use them will be in the general journal. Again, it's the book of original entry, where we record transactions chronologically. So which ones happened first. And then we use the general journal to post to the ledger, which is the third step. This is an illustration of the general journal. You'll notice that on the left-hand side of this worksheet, there's a space with the date. This is where we put the date when the transaction occurred. This is also how we can record business transactions chronologically. In the middle, we have a column called description. For each transaction, we first have to list the 2 accounts that are being affected, and then after we've listed which accounts are being affected, we have to give the transaction a general description. So purchased inventory, or to record the purchase of inventory. It's also important to note that to keep your general journal in good form, the account that you list first in a transaction must be the account that you are debiting. And then the second account is indented, and that is the account that you're crediting. On the continuing to the right, we have a journal reference number column. This is normally where you put in a reference number to the the source document, so the receipt, the invoice, or the sales slip. So you can easily go back and look at, where this information was coming from and how it was recorded. And then the final two columns on the right are your debit and credit columns. This is where we begin to organize how information or financial information is entered into the accounting system. And we'll show you how to do that momentarily. So here are three examples. Okay. Mr. Carlton invests $30,000 in a new travel agency. Number two, a business borrows $50,000 at 8% per year or annually. And then you pay your first month's rent, and it was $1,000. While I'm eager to get to the second step, we first have to ask ourselves, are these transactions? While we don't have any immediate source document from this, like in our slideshow, if Mr. Carlton invested $30,000 in a new travel agency, we would have a shareholders agreement that would be signed, so we would have a source document. If we borrowed $50,000 from the bank, we would have a credit application signed and a credit loan agreement signed, so there would be a source document. And our rent that we've paid, we would get a receipt from. So we would have a source document for all three detailing that these were business transactions. Value was given and value was received. Next, we're going to show you exactly how to journalize them. In the first example, value was received by the travel agency in cash of $1,000. Mr. Carlton gave them $30,000 to buy in ownership to the travel agency. So the travel agency now has $30,000 more cash. Because cash is an asset, we debit cash. And then in this transaction, value was also given. Value was given from the travel agency to Mr. Carlton in the form of ownership interest in the travel agency. Because he bought into the travel agency with $30,000, he now has a $30,000 ownership in or capital in the business. So Mr. Carlton's capital, which is owner's equity or shareholders' equity, is an equity account, and the amount of equity is increasing. We credit Mr. Carlton's capital account. In the second example, we took out a $50,000 bank loan. We received $50,000 in cash, and we have a $50,000 obligation to pay back in the future. And then from this, we can see that this is affecting cash because we are getting more cash, but we also now have a bank loan, and a bank loan is a liability because it is an option to pay in the future. Because cash is increasing and cash is an asset, we debit the cash account by $50,000. Because our bank loan is a liability account and it's increasing, we credit our bank loan account, or in this case, credit notes payable, by $50,000. Also notice that we are debiting and crediting accounts by $50,000, which means our debits are equal. Our debits and credits are equal. They must always be equal. And our last example here, what was it? We paid rent. Okay, so we paid rent. We used cash. We pay an expense, and the expense is increasing, our rent expense. So we debit our rent expense by $100 because that's how we show the amount of the cost is increasing. Okay, so we've paid an expense. And then we credit our cash account to show that we've used $1,000 from our cash account to pay rent. Now, while this was just a verbal description of how you would journalize these transactions, the next slide shows us what the journal would actually look like. So you'll see a couple things going on here. Firstly, everything's being recorded chronologically. which is awesome. So September 1, 1st, 2, 3. Then we have the account names that are being affected. In this case, cash and Mr. Carlton's capital. Sorry, I guess the columns got a little messed up here. So this is debit and this is credit. We wanted to show that our cash was increasing, and because cash is an asset, we debit the $30,000. On the other hand, we also want to show that Mr. Carlton's capital is also increasing. Okay, so our capital account or owner's equity account is increasing, and it's an equity account. To show an equity account that is increasing, we post the amount on the credit side. You'll also notice that at this point, our debits equal our credits, and this is perfect. Next, on September 2nd, we took out a bank loan. Okay, so in our bank loan, we now have $50,000 more cash, but we also have a $50,000 liability or an obligation to pay in the future. Because cash is an asset and our asset account is increasing, we debit our cash account by $50,000. Next, our notes payable or our bank loan account, which is a liability account, is also increasing because we bank loan. We now have more obligations to pay. So we want to credit the bank loan account because credits are how we show liabilities are increasing. And they both equal, debits equal credits, perfect. Our last example here is us paying rent. Okay, so we're showing that we were paying an expense. So we paid our rent for $1,000. Said nobody ever. I don't remember when rent was $1,000 for anybody. We have our rent expense, which is an expense account, and it's increasing to show that we're paying the account or the expense. So we debit the expense account to show that the amount of money we've paid for that expense is increasing. We then want to look at cash and understand how cash is being affected, right? Our cash is being affected because we're paying our rent expense with cash. So the amount of cash we have is going down. So cash is an asset account and it is going down. So how we show an asset account is decreasing is by crediting it. So that's why we've credited our cash account over here. Lastly, you'll see that both our debits and our credits equal. This is perfect. The only other thing I would mention here is again, the good format. The first account in each transaction is the one being debited. So in September 1st, our cash is the account being debited. So we mention our cash first, followed by Mr. Carlton's capital. On September 3rd, our rent expense is mentioned first, and that's because we've debited our rent expense by $1,000. Lastly, second to last, we indent the second account or the account that's being credited. And then lastly, for real this time, we give a brief description as to what the transaction was. So in this case, it was an owner's investment, or a better description would be to record an owner's investment. Keep calm. This kind of material definitely takes some practice, especially with issue identification, figuring out which counts are being affected. Again, you really have to look or read the transaction and say, okay, where is money going and where it's coming from? And then once you know where it's going and where it's coming from, you basically know which accounts are being affected. You then have to understand how each account is being affected. And then using the debits and credit rules, post that transaction to the general journal. Consider this. So what kind of transactions are you going to have in running a restaurant? You're going to have to pay rent. Absolutely, you are. I'm going to change the color this time. I'm going to change it like green. You're going to have to pay rent. You may have to pay interest on loans. You're going to pay some marketing fees and some advertising. You're going to have to pay staff. So what's that? Wages. You're going to have to pay for food and beverages. That's inventory. You're going to have to pay for linens so people can wipe their faces, or cloth so you can clean the line. You're going to have to pay for repairs, like things break, right? There's maintenance that you're going to have to perform on the building that you reside in, and you're going to have to pay for equipment, or how else will you produce food items? You can't store food if you don't have a walk-in. You can't store food on the line unless you have a cold or hot drop. So the point I'm trying to get at here is there are going to be lots and lots of transactions that are going to happen in your business, literally on a daily and weekly basis. All of these transactions become journal posts. So it's important to be able to organize these transactions so that when you produce your financial statements, they are accurate and without a processing issue or a technical issue. Try and also consider and think about what revenues a restaurant would have, right? Food revenue, beverage revenue. If you do catering, you could have catering revenue. You might also try and think about how often these sales happen, right? On a daily basis, you are continuously selling dishes and beverages, maybe even catering to your customers, right? So at the end of the day, you have food, beverage, and catering revenue to record. All of these turns into journal transactions. So here are some examples that you can work through. These are examples of journal post or journal business transactions that I've come up with. So you've paid $3,500 for a new oven. You've purchased $1,000 worth of food products like inventory. Purchased $450 worth of beverage products. You conduct a food inventory and you've calculated your cost of food, and it was cost of food sold, and it was $570. Your food sales for the day were $850. Now, what accounts are being affected here? Okay, so you pay $3,500 for a new oven. Well, where's my pen here? There we go. You paid $3,500, so we can assume that this is going to affect your cash account because you now have $35,000 less cash because you purchased a new oven. So what do you have for that So you've given $3,500 worth of value, and the value you received was a new oven. So we could call that equipment. Okay, so those are the two assets, or sorry, the two accounts that are being affected. Your cash is decreasing, and your equipment is increasing. Next, you purchase $1,000 worth of food products for inventory. So this is affecting cash because you've paid cash, so your cash is going down. But the value you received was food products, so your inventory is going up. So those are the two accounts that are being affected. Let's go down to food sales here, okay? So your food sales for the day were $850, okay? The value that you're receiving was $850. So this is going to affect your cash account because the amount of cash you're receiving your cash is increasing because you're receiving cash from sales. So your cash would be increasing. But you're also recording that you've generated some food sales. So you would also, I'm just going to put FS here for food sales. You're also going to want to show that your food sales are also increasing. So your food sales increased because you sold food during the day. And as a result, your cash also increased. On the next slide, or the next couple of slides, I've shown you how I would record these these transactions in the general journal, okay? Except that it's gotten all mucked up, okay? So cash is being credited over there, over here. This one's fine. It shows you how I've organized these transactions or how I've recorded these transactions by using the account that were identified and using the debits and credit rules. So here's the last two. There was cost of food. Food inventory was decreasing. And then our revenue. So here's where we get into our workshop. So while I'm not going to be there this week, what I want you to do is in your groups, I want you to think of at least 10 transactions your restaurant would have over the course of a month, okay? And you're going to have to estimate how much each transaction is going to be worth. So if you're saying, well, we're going to have to purchase food inventory over the course of the month, you're quite likely right. But how much inventory you're going to have to think of and estimate, right? It doesn't have to be accurate. You just have to make sure some numbers are included, or you won't be able to record these into the general journal. Okay. I then want you to document these transactions in the same Word file that you use to identify your list of accounts from this week. And then I want you to use the general journal worksheet posted under class 3 on Blackboard to post your transactions. Once that's complete, could one member of your group please submit a copy of your transactions and your general journal to Dropbox. I'm going to look to make sure this is completed over the course of next week. When I return the week after next, be prepared to present and discuss your results with the class. Before you get into groups and think of your transactions and start posting those transactions to the general journal, please watch the video that I've posted about how to post to a general journal. So there's a bit of a tutorial video that I've posted to help you understand how exactly to use the rules of debits and credits in conjunction with various business transactions in order to complete a general journal. Anyway, thank you for watching this video. We'll see you the week after next.